Welcome everybody. So thank you for joining us this morning. Those of you that could make it, welcome to our importing and exporting session with Grant Thornton, Ask the Experts, which they absolutely are. My name's Sam. I'm the Partnerships and Events Manager at the Growth Hub. So any questions you have throughout the session, if you want to pop them in the chat, I'll pop a little test in there now so that you can see where that is. But any questions, pop them in there. And then once Adam and Kevin have gone through their sort of 20 minutes-ish of presentation, we'll then open up to questions and some discussion, and you can ask away to your heart's content. So without further ado, over to you, Adam and Kevin.
Morning, Sam. Thank you very much for that introduction. Morning, everyone. I will start by sharing my slides. As Sam noted, this is importing and exporting Ask the Experts session. What we're going to focus on today really is changes since the 1st of January 22, and these really relate to post-Brexit changes. These are further updates to the rules in place since we left the European Union. I'm Adam Taylor. I'm an associate director, not a director, in our Customs Excise and International Trade team. I will cover the customs elements. Let me, before I go on to that, introduce my colleague, Kevin, who's an associate director in our VAT team. Morning, Kevin.
Morning. Yeah, as Adam said, yeah, associate director on our VAT team, and yeah, I'll be covering I suppose the VAT angle on a lot of these changes since 1st of January. Just giving a bit of an update on that.
Great, thank you very much, Kevin. So let's move on. Welcomes and introductions. I'm going to talk through some changes called the introduction of the full border control model. We'll look at some other customs considerations. There's been some changes, international changes actually related to commodity codes and classification that are certainly worth considering. As Kevin noted, he will do a bit on the VAT considerations of these. And then as Sam said, look, you know, really a question and answer session. We really are here to answer your questions, not talk at you for however long. Please feel free to interject or wait till the end, or as Sam said, by all means use the chat. But let's start with these initial customs changes from the 1st of January 2022. Now some of you may recall, upon leaving the European Union, HMRC allowed for simplifications in the customs declaration process for imports from the European Union. This was particularly goods arriving in roll-on, roll-off locations in the UK. And in essence, rather than submitting a declaration, you could gain a authorization for simplifications that allowed you to bring goods into the UK without making those declarations, but making the declarations at a later point, potentially as much as 6 months later. Now, from the 1st of January 2022, in terms of this movement to a full border control model, those easements have generally been removed, and customs declarations are now required for all imports and exports. Furthermore, the easements that were in place for agri-foods during the 2021 period, they've also been removed, and controls are now being introduced that include prior notification. Now, as I'm sure you appreciate, agri-food is a particularly sensitive area, whether that's in relation to the Northern Ireland Protocol or general EU trade. And these requirements will be introduced slowly over time. They're going to involve the use of a thing called a BCP, a border control point, and different border control points will become live for those agri-food imports at different stages. So it's certainly worth keeping an eye on those changes if they affect your business. And the other big change we're seeing relates to, in essence, the Brexit deal itself and how you prove your goods qualify for zero tariffs going into the EU, or how goods you're buying from the EU qualify for zero tariffs coming into the UK. And that's all based on the origin of a product, in essence, where it was manufactured or last underwent significant processing. Now, there was an easement during 2021 where you could make your origin declaration, i.e. you could say these goods are of UK origin and qualify under the Brexit deal. But you didn't need to necessarily hold the evidence on file at that time if you were confident you could make that declaration. That easement will also, or did also, come to an end in January 2022. So practically how this plays out is that if you're making a declaration that your goods are UK origin and qualify for zero duty entry into the EU for your customer, then what you'll now need to have is evidence that you meet the rules of origin for those goods, and different goods have different rules of origin. And it may be that just your manufacture of a particular product is not enough to confer that origin, that UK origin, and that you need to look at some of the constituent materials, components, sub-assemblies, and check on the origin of those and hold that evidence prior to issuing that statement of origin to make sure that your goods do qualify. Now, from July 2022, we have further changes coming in. And again, these might be quite sector specific, shall we say. So phytosanitary certificates and physical checks on sanitary and phytosanitary SPS goods at those specific border control posts. Now SPS goods can be things like live animals, plants, products of animal origin. It's a pretty wide net that's cast there. No pun intended, but it does cover fish. There's also a new requirement for health certificates for exports of those SPS and animal and plant products. And more wide-ranging is from July 2022, there will be a requirement to, in effect, pre-notify imports and provide a safety and security declaration. And in essence, the safety and security declaration provides a short summary detail to HMRC of what the goods are, who the consignee and consignor are, those kind of details, and allows them to undertake appropriate risk measures before deciding if goods will be stopped and checked at the border. The reality is that the UK currently checks about 0.5% of imports, so goods generally don't get stuck at borders unless there's something significantly wrong. If we then move on to a bit more detail on this full border control model, as I said, this actually applies to all sectors, and it's a change from those simplified entries or no entries and postponed import entries submitted at a later date to a position where customs declarations will need to be made at the time goods are either leaving or arriving to or from the UK. Now, there is still scope to provide some simplifications for that process, but you now need to be approved for what's called CFSP, Customs Freight Simplified Procedures. CFSP allows you to make a simplified border declaration and follow it up at a later date with a more detailed customs declaration. The other thing that these changes will create is a situation where, without those easements, trade with the EU will become much more akin to trade with the rest of the world, so the US, China, probably more also like places like South Korea or Japan or Canada, where we do have those free trade agreements, and issues such as pre-notification will come in, but also those rules of origin are also currently in play. As we said, there are those changes to product origin rules. Let's look at some other changes and necessary actions resulting from the introduction of those amendments. So this is this wider piece on commodity codes. So for those of you not familiar, when you import or export goods, you need to classify them with a commodity code in a thing called the customs tariff. So this is a list of codes that allows identification of a particular product, its technical characteristics, and provides an 8 or 10-digit code for the relevant product. The UK tariff has about 16,000 codes. Now, from 1st January 2022, the WCO, the World Customs Organization, has introduced 351 amendments to the tariff, across a whole range of chapters affecting about 5,500 commodity codes. Particular changes: electrical and electronic waste, novel tobacco and nicotine-based products such as vapes, drones, smartphones, and there's been various other changes. No, there are some actions to take from these changes, and these are listed here, and let's just run through these. So review and change your existing commodity codes to ensure that you're capturing those changes in the updated tariff, and you can find the tariff on HMRC's website, or if you type trade tariff in Google, it would be the top link. If you're operating any kind of authorizations or release from HMRC, those tend to be commodity code specific. So it'll need to be amended if the changes introduced on the 1st of January actually affect the products you're authorized for. Likewise, people may hold rulings from HMRC on the classification of a particular product. And again, we'd advise that those are reviewed and checked to see if they're affected by the changes and whether you actually need to make a new tariff ruling. The potential outcomes of this really are, if you're using invalid codes on a customs declaration, or your freight forwarder is using an invalid code, the entry will be rejected and you'll have to put in a correct code that's in fact valid. If an incorrect code is used, then the risk there is related to an under or overpayment of tax, because your duty rate is attached to that commodity code. So an incorrect commodity code risks an incorrect duty rate and either an under or overpayment. So moving on from here, let's just have a look in a bit more detail at these rule of origin changes and these supplier declarations. As I noted, the Brexit deal, the TCA, the Trade and Cooperation Agreement, allows a preferential rate of customs duty on goods originating in either the UK or the EU moving between those parties. If you export goods to the EU and you provide the EU importer with a statement on origin, you may now need to have those supplier declarations in place if the manufacturing you do to the product is not sufficient to confer origin on its own. As we said, those supplier declarations are needed as part of the wider piece of you confirming the origin of the goods that you're exporting when that manufacturer is insufficient to meet the rules. What I would say is we'd expect more checks from HMRC, as certainly COVID rules are relaxed and officers are more likely to come and do in-person audits, but also as the TCA agreement beds down, then HMRC will start having more case law it can rely on, and how that implementation should be checked and measured. I'm also expecting to see some more checks instigated from EU tax authorities, because the upshot of the origin piece is that if you make a declaration in the UK that the goods are UK origin, the tax benefit is received in the EU recipient territory by your customer, and therefore the tax authorities there are the people that would instigate a check on that declaration by you. And obviously there's no tax impact in the UK for that. There may be a commercial impact for you in terms of your relationship with your customer, but HMRC can issue penalties for incorrect statements of origin, so certainly one to look out for. If we move on, I think the upshot of everything I've talked about, and obviously we've got changes this year and we'll see more changes in things like the Northern Ireland Protocol, I'm sure, but in terms of customs compliance, I think the same basic rules continue to apply really. Customs compliance is built around 3 pillars: classification, what is the product; origin, where did it come from and does it qualify for a preferential rate of duty; and valuation, what's its value upon which to base any tax that's due. These 3 pillars, they provide the basis for customs declarations, compliance, and the tax calculations. These are generally done by freight forwarders, these declarations, so you should obtain a copy and check key details such as the classification, the origin, and the value. Understand the Incoterms and associated responsibilities under which you buy and sell. Now, Incoterms are the terms of trade which you either supply to customers overseas or purchase from customers overseas, and they're absolutely fundamental in ensuring the right people are importing and exporting goods and the right party is paying the tax. And the other thing we see often is customs doesn't sit comfortably in any part of the business. So just bear in mind that it can easily drop through holes between finance, supply chain, procurement, and various other departments. So it's one just to be comfortable where the responsibilities for it lies. I think this is the point where I hand over to Kevin to cover the VAT position.
Yeah, thank you, Adam. Yeah, if you want to flip on to the next slide, I can have a little chat through some of the V80 implications of the recent changes in terms of Brexit. So I thought it'd be worth just so there's nothing. And obviously on the customs side of things, there have been some changes that have taken effect more recently from the beginning of January. From a VAT point of view, there's not been any specific changes from January, but it's worth maybe recapping on just on where we currently are post Brexit. So since leaving the EU, essentially we're no longer part of the single market. And as such, the VAT rules that apply to trade within the single market, particularly in relation to goods, have all essentially fallen away. So what we have now is a position where all of our sales from the UK, any sales where goods are leaving the UK, they're going to be treated as exports. Now, from a VAT point of view, these should qualify as zero rated. Obviously subject to a number of conditions. And one of the key things is making sure that you have all of the relevant evidence to demonstrate that the goods have actually been exported out of the UK. And essentially that's the basis from a VAT compliance point of view, that's the basis to support your zero rating, essentially not charging VAT to your customers. And what we're actually seeing at the moment is quite a lot of focus from HMRC. Indeed, there's been a couple of recent cases on this in the courts, where HMRC are putting a particular focus on that retention of evidence. And the one to flag there is, as obviously Adam mentioned, the importance of Incoterms, as in the basis on which you're trading with your suppliers and customers, and particularly where you are using ex works Incoterms. That's where the customer is actually collecting from your premises and actually processing or essentially exporting the goods themselves. The evidential requirements become more important there, because essentially the business selling is no longer in control of that export. It's the customer who's going to deal with it. So I think paying particular attention to evidence of exports becomes much more important now that we're outside the EU. The other thing that falls away on the sales side of things is where we're making B2C sales to customers in the EU. Historically, we would have had the EU distance selling rules and certain thresholds that you would have to reach before you triggered additional compliance requirements in other EU countries. And I'll come on to what sort of replaced that in just a moment, that the international or the import one-stop shop. I'll talk a bit more about that in a moment or two. So as I mentioned there, just the key thing is understanding the Incoterms that you're using when you're actually selling, and who's actually got responsibility in relation to the import in the destination country, who's responsible for paying any import costs, and how that's going to work in practice. And what it may mean is that in certain cases, if you are moving goods into an EU country for onward sale, in some cases, depending on how you're structuring that, there may be a requirement to register for VAT and similarly account for the import VAT in that country. So it can trigger additional compliance requirements that wouldn't have been there pre-Brexit. So moving on to the next slide, if you can, Adam. The next slide, if we look at the import side of things, so obviously now buying in from EU suppliers, as Adam mentioned, all of the imports are going to now be subject to full customs declarations. And what that means is that you're obviously going to have to pay import VAT on those goods imported into the UK. And it's just worth remembering that the import VAT paid will be calculated on the inclusive value of the product plus customs and excise duty that's payable. So again, underlines the importance of getting the tariff classification correct, getting the procedures right to make sure you're not overpaying duty on the import. And in terms of how that gets paid, if you're maybe a larger importer, it may be the case that you've got a duty deferment account set up with HMRC, whereby you would defer the import VAT and potentially duty as well, and pay that essentially pay that monthly following the usually it's 15th day following the month of import, and you'll defer it at the point of import to clear it quicker, and essentially pay that at deferred date. Alternatively, you might see where you're importing now, if it's been cleared by the freight forwarder or the courier, they may actually pay the VAT through their own deferment account and then simply recharge that cost, recharge that import VAT cost onto you. Or the final option there is postponed import VAT accounting. Now this was obviously introduced from January 21, and essentially this is a kind of simplification that allows you to essentially treat the import VAT in a similar way to how you would have done on your VAT return when you were buying in from the EU. So essentially, instead of paying it to clear the goods through the border at the point of import, you'll get a PIVA statement from HMRC, and that then gets accounted for in your VAT return. So you would account for the customs duty, or sorry, the import VAT on your VAT return as a liability, and then recover that as input tax where you're eligible to do so. So it's just I suppose it's just important to understand how you're actually paying your import VAT and making sure that you've got the right documentary evidence for reclaiming that through your VAT return. The next point to just note as well, and again harks back to that point Adam made about understanding who's actually taking responsibility for declarations and for payment of any liability. So from an import VAT point of view, so obviously the importer of record, whoever's actually making that declaration as the importer, they're liable to pay the import VAT that's due on the goods coming through customs. But what can cause issues, and what HMRC are quite hot on at the moment in terms of looking into these cases, is where you have the importer of record is a different person to the actual owner of the goods. So HMRC's policy is that it should be it's only the owner of the goods who would be entitled to recover import VAT that's incurred when the goods are cleared through customs. So you might have this situation where you have a company which is working on goods that are imported, so a supplier's goods, goods owned by one company in France, for example, imported to the UK for work to be carried out, or testing, possibly clinical trials is quite often an area we see this. But the person who's actually importing them and actually carrying out work on them doesn't physically own title to those goods. And that causes a problem if they're the one who actually pays the import VAT when you bring them into the UK. So again, it's just important to understand who actually is liable for paying those costs, who's actually doing the customs clearances, and who's actually going on that record, on that declaration as the importer of record. And as mentioned before, just key to understand the implications of those Incoterms that you're using on the import. Who's got responsibility for paying any of the costs? If you want to flip on to the next one, Adam, please. So just a quick recap through postponed VAT accounting. So as I mentioned, this came in at the beginning of January last year. So you don't need to get approval from HMRC, but you do need to sign up online to access postponed import VAT accounting statements. So you download your statement, and essentially that's what you would use as the basis to put the import VAT through your VAT return. So essentially, it's just understanding when you're actually importing, whether goods are actually coming through, or how you're actually paying the import VAT, whether that's coming through postponed VAT accounting, whether that's something you're paying sort of through a deferment account, which and also whether that's coming through as a sort of recharge by the freight forwarder or courier. And I think it's just from the point of view of actually managing this in practice, the difficulty can be making sure that your freight forwarders and shippers are actually using the right method, and that you've got visibility of where the VAT is actually or how the VAT is actually being paid in all your imports, and be able to reconcile that with what you're expecting in your VAT return. Again, harking back to the records point. Again, it's something that making sure you're able to kind of substantiate the VAT paid, and you've got the relevant evidence before putting that through the VAT return. If you can flip on to the next one, Adam. And this is just, as I mentioned before, where you're doing B2C sales, one of the key things that has changed since last year. So from July, essentially, the EU introduced the import one-stop shop. So this is kind of essentially replaces, from a UK point of view, now that we're outside the EU, this replaces largely the kind of distance selling rules that we would have used prior to Brexit. So essentially, this is if you maybe remember back to the beginning of the first half of 2021, we were seeing a lot of suppliers having issues where they were selling to customers, B2C sales to customers in the EU. The customers were having a lot of issues in terms of actually getting the goods cleared through customs, being hit with additional VAT and duty costs that they maybe weren't expecting, things taking longer to actually clear and get to the customer. So essentially, that's what the IOS regime is kind of seeking to simplify. So where you're actually selling to a customer in a B2C sale to a customer in the EU, and the value is less than 150 euros, what happens is that under IOS, the UK supplier will essentially charge VAT based on where the customer is actually located. So if it's in France, you'll charge account for the French rate of VAT on that sale. Germany, likewise, etc., for all of the 27 member states. You then file as an IOS trader. You would then file an IOS return, and obviously that paying the VAT across all EU member states through this one-stop shop return. What you do need to do, though, is obviously need to be registered in an EU member state. Obviously, the UK being outside the EU, you need to have a registration in an EU member state for the one-stop shop. And again, being outside the EU, what that does require is a representative, fiscal representative within the country, who is jointly and severally liable for essentially declaring and paying your one-stop shop returns. So essentially, this replaces where sort of low. Sorry, prior to Brexit, the EU had a regime whereby you could import goods under the low value import scheme. So anything under 22 euros was just treated as kind of not subject to import VAT and duty, and essentially allowed to kind of flow through. Obviously, the value is now up to 150 euros. But what it does obviously bring in the additional requirement for the IOS returns, where you have to declare and pay the VAT through that one-stop shop out to each of the member states as appropriate. And it's important to remember, if you're selling items or consignments above the 150 euros value, then the normal customs declaration would be required to be followed. So the goods would have to clear customs and obviously be subject to import VAT and potentially duty at the point of entry into the EU. And there's obviously it depends on how your supply chain is structured, whether that's you as the supplier who's responsible for importing those goods into the EU, or indeed the customer responsible for paying those costs and clearing them through customs. So again, that goes back to the point around the importance of just understanding the terms on which you're selling, who's got responsibility, and who's liable for paying any costs coming through. So I think that kind of wraps up the summary that I was wanting to run through. So I don't know if we want to move on to any questions from there.
Yeah, thank you, Kevin. Sam, I think over to you. I don't know. I saw a couple of things on the chat, but my technical nervousness didn't want me to click on them in case it all came down like a house of cards.
That's fine. So we do have a couple of questions in from Andy. I can actually unmute you, Andy, if you wanted. We can sort of make this a bit more of a discussion, which may be useful. So I've given you the option there to unmute. But Andy asks, will one have to prove UK manufacture of goods if manufacturing electronic equipment using bought-in electronic components?
Hi, Andy. Anything else you want to add to that before I give you some initial thoughts? Okay, let me start then. So in essence, Andy, how you determine the origin of something is you have to look at the agreement in question. So let's assume it's the Brexit deal. You look in the Brexit deal, you find the first 4 digits of your commodity code, it's called the tariff heading, and there will be tariff heading specific rules of origin. So you will see in there a particular rule or rules, and it will say one of two things usually. It will be either a tariff heading based or a value based rule. So if it's a tariff heading based rule, it may say something like the tariff heading of your finished product, so the product you're declaring origin on, must be different, a different tariff heading to all the constituent parts tariff headings if those parts are non-originating. So in effect, what you're showing is the stuff you brought in through the change of tariff heading, you are doing significant processing to convert origin. That's one way. The other way is to look at it from a value perspective. And the rule may say something like no more than 40% of the ex works price of your product can be made up of non-originating materials. And in that case, you need to look at your ex works price. You need to look at your bill of materials. You need to look at things like labor, profit, general overheads, because those are UK origin costs. And it may be that you then need to actually start looking at particular components and saying, right, to get over the 40%, to make sure it's UK origin, I need to obtain certificates from a particular supplier down the road who we think is UK manufacturer. That will get us over the limit. We're comfortable then, we can make the declaration. Andy, does that answer your question?
I think he'll be in the chat. Adam, he's got a problem with his mic.
Right.
He has also added, yes, that's great, thank you. He's also asked, what proof does an importer require to claim VAT? Does an originator of goods invoice suffice?
So kind of one for me and one for Kevin. So the invoice will be the basis for completing the customs declaration. And the customs declaration in box 8, if you're named as the importer in box 8, will include your EORI number. And the EORI number in that box then drives the allocation behind the scenes into either the old C79 system or the new PVA system. And that will then give you the details of that import to be able to evidence that you can recover that import VAT, obviously subject to being owner and things like that. But yeah, the invoice feeds into that declared customs value, that one of those 3 pillars of compliance. Is that okay, Andy?
Hopefully.
Okay, I missed.
I do have another one that has come through to me on email.
Okay.
I'm not sure if they are still on the session, from Stratos Performance. So if there are any specific trade deals with other countries, are there ways to reduce the fees our customers pay to import our goods?
Yes, so you need to check which countries the UK has trade deals with, and it's quite a lot of them actually. Certainly, I think about 99% of the ones the EU had have been signed over to the UK. Obvious ones in addition are things like Australia. New Zealand is close, but you've got South Africa, Japan, South Korea, the EU, the EFTA states, the EEA states, Canada, Mexico, a few other South American countries. And then there's other deals with less developed countries that are unilateral deals. So we just grant access on imports, trade, not aid kind of thing. So what you do is you find out if there's a deal. And then as I explained to Andy, how you do that exercise in terms of whether your goods qualify, each agreement has those kind of rules in it. You find your heading, find the rule to apply, do the exercise. In that agreement, it'll also tell you what the proof of origin is. So for us trading with the EU, it's an invoice declaration currently, quoting our EORI number. But for other trades, such as with South Korea, you need to be what's called an approved exporter. And that takes quite a bit of time in advance. You need to give yourself probably 2 or 3 months to get that status before you can be certain that you can make the approved exporter declaration, which would allow your customer to get tariff-free import on your goods.
Excellent. Thank you, Adam. And then I've got a couple here, probably for Kevin, but I'll leave that between you two. Does a UK business need to register for the import one-stop shop if it only makes a small amount of B2C sales to the EU?
So the one-stop shop, it is an optional scheme. As I mentioned, it's kind of simplification to save you having to go through that full customs declaration process. So if it is only a few supplies, a small volume of supplies to the EU, you may want to just simply go through that full declaration route. There are other rules that come in if you are selling through a marketplace. Typically, whether it's kind of a fulfillment by Amazon or whether it's through eBay, for example, there is an obligation for the marketplace to actually register. So if you are selling through a marketplace and it's low volume, you wouldn't necessarily need to register. It may be the obligations on the marketplace. But as I say, it's an optional scheme, so there's no requirement there to register. It just might mean it does just make it simpler, and from the customer's point of view. But obviously, it depends on depends on volume from there.
Okay, brilliant. Thank you. We've got a couple of others come in, so I'll just go in order. That last one that I popped in there. So, can you explain a bit more about the evidence required to support the VAT 0 rating of an export?
So in terms of 0 rating, as I mentioned, HMRC are quite, there's been a bit of focus on this quite recently. And essentially, for export, you're required from a VAT point of view to obtain and retain on your records evidence that the goods have been exported within the time limits, and normally that's within 3 months. So typically, if you're using obviously commercial freight, typically the evidence that you'd be looking for there would be either an authenticated seaway bill or airway bill. Looking for consignment notes, a certificate of shipment, which obviously has sort of full details of that consignment and the route through which it's left the UK. There's also, you'll be able to get official evidence, and Adam, you maybe want to expand a little bit on this if I'm not doing it justice. So when the declaration is made on the chief system, which I think is changing, isn't it? The export system, you'll get a goods departure message, which is essentially your official evidence that that consignment has cleared as an export. But essentially, any supporting documentation is useful to understand, to basically evidence what your evidence that shipment, and making sure that you retain those records and have processes in place to make sure that that's obtained as practice in the course of actually consigning goods for export.
Adam, did you need to add anything?
No, I think Kevin had it covered perfectly. The goods departed message is a part of the customs declaration process, which is in effect HMRC saying, yes, we know these goods have left. So it's absolutely perfect evidence. But as Kevin said, it's about having a suite of evidence and not just a piece of paper. You know, so nothing to add on that, I don't think. No.
All right. So our next question is from Laura. I'll read it out, but Laura, I have given you the option to come off mute if you would like to expand on anything. And just going back to the paperwork side of things here, when sending goods, do we have to print out and physically sign the invoice, or can this be generated by software and printed on the paperwork?
Laura, is this in relation to origin statements?
She might be typing. Oh, are you there, Laura? There we go. Yes, yes, it is.
Fine. So no, generally you can print them out on an invoice. That's absolutely fine. What I would say is if you're making what's called a long-term supply declaration or long-term statement of origin, which covers an extended period, then those tend to get printed on company-headed paper and signed. But generally, the key is that you follow the wording in the Trading Corporation Agreement, the TCA. And printing out is fine as long as you quote your EOI number and use the exact wording generally. Electronic signatures generally are okay as well. To be totally honest, Laura, sometimes these things actually just come down to, is the customs officer having a good or a bad day if and when they stop the goods? You know, generally as a rule of thumb, you would be fine printing it. Does that answer your question, Laura, or do you have a follow-up?
She has just added in the chat there, do we need to ink stamp or is it okay printed?
It's generally okay printed, exactly the same thing, you know. About 20 years ago, I worked for Panasonic, and we used to have lorry drivers come in from Eastern Europe before it joined the EU, and they used to be absolutely insistent I ink stamp their paperwork. Didn't care what stamp I used as long as it had some kind of stamp, and in the end I resorted to just a date stamp, and it seemed to satisfy them fine. But generally now things are a bit more electronic, but you will find the odd occasion where people, you know, wanted in blood with a photo of you next to it and all sorts. That's just the nature of crossing borders sometimes. Andy,
yes. Can you see that, Adam? Would you want me to?
I can. So criteria for VAT deferment importing, minimum 80,000 turnover required. Andy,
yeah, I was going to say, I think that's probably a little bit crossing over the VAT and customs side of things, isn't it?
Yeah. I think the last time I looked at VAT, probably, Kevin, the VAT threshold was 57,000. That's how long it's been.
Well, let's say we're up to 85 at the moment. But I think in terms of actually a deferment account, there shouldn't be any turnover threshold at all if you're looking to set up a deferment account with HMRC. But typically, it's I suppose it comes down to a commercial decision as to whether you feel you need a deferment account in terms of the values and volumes coming through that. Because obviously, what you typically need from a deferment account is a guarantee. It would need to be backed up by a guarantee from the bank, and usually that's double your deferment, your monthly deferment limit, and the cost of doing that. Depending on what the value of your imports are, or the value you're expecting to value of duty and import VAT you're expecting to put through that deferment account, you need to weigh that up, I suppose, in terms of the additional costs and responsibilities that come with actually setting that up.
So if I could add as well at this point, the PVA or PIVA, postponed VAT accounting requirements, and Kevin talked through, mean that you probably don't need to include import VAT in a deferment account limit anymore, which obviously VAT at 20% would generally be much higher than the duty rate. So the big majority of your guarantee would have always been import VAT. So if that's gone through PVA, we then need to think about the duty, which the duty deferment amount would cover. As Kevin said, your limit needs to cover 2 months, but it's worth doing a bit of digging because the UK has reduced and eliminated an awful lot of tariffs on things, not just EU stuff, but for everyone. So it's worth seeing what your potential limits per month are. The other thing I'd say is a further easement introduced by HMRC in 21 and still there is that if your deferment account limit, monthly limit will be less than £10,000 of duty, then you're almost certainly not going to need to provide a bank guarantee. If it's over £10,000 and you can show a decent net asset position, then again, you may not need to provide a guarantee. If you are non-established in the UK, you may be able to operate a duty deferment account here, but you will always need a guarantee in that situation. So for a lot of people, the guarantee requirement has gone, Andy, particularly if we're talking 10k of duty. Now, 10k of duty is a decent volume and value of imports when if you look at a 5% duty rate and multiply that up. So it's worth doing that digging, finding out what the answer might be, and potentially making an application, because it does provide a bit of cash flow benefit. It may provide some cost savings if your freight forwarder is charging you to use theirs and you've got your own without a bank guarantee charge, and there may be some savings there. So certainly worth looking into.
Brilliant, thank you very much. Do we have any more questions? I can't see any more in the chat at the moment.
No.
But anything anyone else would like to add? This session is being recorded, so following this, we will send you the link to be able to watch it back. So if you need to go over anything, and if that does prompt any questions after that, then you're more than welcome to get in touch with us, and we can direct you to Adam and Kevin for that support. We are running this session again on the 9th of March. So if you would like to hear everything again, you're more than welcome to join us on the 9th of March. And the link for that, the details are on the SEMLEP Growth Hub events page. So you can book there for that. But I think I'll take a minute just to say thank you very much to Kevin and Adam for that session. That's been brilliant and really, really useful. And I think there's been value in that for hopefully everybody that's been on the call. We've had loads of questions as well. So it's definitely sparked some thought there with people that came this morning. So thank you very, very much, guys. And yeah, wish you all a lovely rest of the day.